Sanlam Private Investments delivered its quarterly briefing earlier today to discuss the quarter that was. Alwyn van der Merwe, Director of Investments at Sanlam Private Investments, joins us in studio. Are you as positive as Paul? Well, David is also positive on the markets. Are you somewhere in between when it comes to the economic environment?
I think I share David's views. I don't share the optimism of Paul, but I don't think South Africa will go into recession. But it's the economists that forecast 3% growth rate. I think they're too optimistic, because I think the one thing that worries me slightly longer term, Paul, we had a windfall with very, very strong commodity prices that was fantastic for the terms of trade for South Africa. And consumers were the beneficiaries of that. And if you think that those commodity prices can come under pressure, the terms of trade will change. And the consumer will be on the receiving end of that. Remember that the currency was also a major beneficiary of the strong terms of trade. And a strong currency is good for one person, that is the consumer. The business sector, of course, the exporters, they love a weaker currency, but the consumer will struggle. And that is, I think, the one thing that concerns me slightly longer term. All the arguments that you make about...
People have been saying that for a year, by the way.
No, but it's...
Or 2 years.
Yeah, you're right, but eventually it will come.
Okay.
The other thing that has certainly boosted consumer spending is, as you say, government employees. If you speak to Capitec, a major portion of their clients are government.
It was the point that Annabelle was making.
Employees. So, and that will certainly, I still think, continue. So I don't think it's doom and gloom.
We just need to all go and work for the government. all right. I back down.
Let me come back to the
That's
market.
Europe. That's a European story.
We're speculating on all of this, and that is where, I think, it's always a bit easier to talk about the market, because at least there's one thing in the market that you can talk about and say, okay, what do you think about valuation? And I think particularly if you talk about global stocks, I can certainly see pockets of value emerging in global stocks. And the South African market is slightly tougher.
But before we move off the global hotspots, so to speak, where are they? Because it's a big place.
You will probably find that... traditionally you find two camps. You find the Kokkie Kooiman camp, if I may, that love emerging market stocks. Traditionally, Kokkie's changed a bit, and then you get the Piet Viljoen camp, if I may. Piet might blame me for that.
All Capetonians.
No, absolutely. They go to the most unloved markets.
They are the major money managers in South Africa, aren't they?
What?
In any case. No, and Piet will say, look, I can get emerging market exposure by buying developed market companies that trade at a pretty decent multiple, and I don't have the corporate issues that I often have buying an emerging market company. But I think, you can look across the world. It doesn't necessarily mean that it sits in a particular place. I think
there are pockets of value in every territory, effectively, in the developed world.
You just need to run a Bloomberg screen on price earnings multiples or dividend yields, and it will give you an amazing amount of shares, well-known names even in South Africa, where you can invest into those shares.
Right. Now
even some of the IT companies are starting to look interesting. Microsoft is, I think, a good example of an IT company that looks interesting.
You were coming to your perception of South African equities when I really interrupted you.
No, it's not a problem. For me, South Africa is more difficult because, like in the rest of the world, people found comfort in the so-called defensive shares. So British American Tobacco, SA Breweries, for instance, two examples where we have certainty in terms of the earnings outlook, but we were quite prepared to pay very high multiples for them. So from a value perspective, it's very tough to justify holding those shares because they are arguably expensive. On the cheap side, you have small caps, some mid caps, but if you talk sectors, the resources shares, I think, must look interesting because on a price earnings multiple basis, those shares certainly do look interesting.
This is a debate that David brings to the table all the time.
Yeah, but the problem is,
depending on what earnings you get.
Exactly, but that is the point I want to get to.
I think they're looking very attractive, and I agree with Alwyn. What my view on the market is, I would go 100% offshore to those companies. I think that a lot of ours are looking very expensive, and I always see South Africa as nothing more than a convenience store. We've got a few that you can pick from. Go overseas and you've got a whole host at very, very attractive values.
Yeah. But, I don't think the resource story is such a easy one because, as Paul has highlighted, you've got to think about the earnings. I think some of the commodity prices are still pretty elevated. People, they anchor themselves to the recent past. But if you go back, and quite often people make the mistake, they only look at the bull market that started in 2000. You should actually, to have a view on commodity prices, go back and look back to the 60s and look at them in real terms. And the one commodity that worries me a bit is iron ore, because it's been pretty high and it stayed pretty high. And I think that is one of the reasons why Anglo's has been under pressure, because some of the analysts are saying, look, we're not exactly sure what will happen to the iron ore price.
From a number of people, caution over iron ore prices.
You know,
but you know, just on that, today China announces $23 billion of steel projects. You know, against that, the iron ore price, what's it back at $140, $140
and
a ton.
a cut in interest rate.
Yeah. So it hasn't quite shown. Everybody's expecting more production to come on soon, and yet the price is holding despite all the negativity. Yes, it's come from 180 to 140, but cost of production for someone like Kumba is 40.
Exactly.
They've got a $100 margin still.
But that is, you see, Dave, but that is exactly the thing that worries me, because if you make those kind of margins, I know, you know, you've got to have the resource, but if your ROE, I mean, that is just how markets work. High prices ultimately lead to low prices. If the ROEs, or in other words, the profitability of a particular company is very high, it will attract competition, and ultimately it will push it down. The opposite is also true. That is why I think platinum for me looks quite interesting.
Oh, no.
No, but I tell you
we've got an interesting debate coming on here.
That's right. It looks interesting.
Because the platinum companies struggle to make profits. So what will they do? They will cut production.
Cut back production.
And
supply
ultimately,
then
what will happen
is
with the platinum price?
exactly. It's economics, demand, supply, constrained.
Exactly, but
I
just
think
have a
I'd like to
different
show a
approach.
chart of Impala Plat and Kumba iron ore. You know, the one goes from the bottom left-hand corner to the top right. The other one goes from the top left-hand to the bottom right. You know, and you say, bit worrying.
But where do you want to be if you want to make money going forward? That's the question. Is it too early?
That is perhaps the issue. When we manage, remember, we manage private clients' money, and they are very conscious about the book value on that statement. You would know that. So if you buy Anglo's today, and in 10 days' time we've got the election coming up in Greece, and it doesn't pan out the way that you want to, and suddenly everybody's in doom and gloom again, and Anglo's fall to 240.
You bring up a very valuable point.
To
Should
240,
we all be...
You know, what my client will say, but are you mad? I mean, how can you buy Anglo's at 264, 270, wherever they traded today?
You bring up a very valuable point. Should we be waiting till after the 17th of June? Because because obviously then if it goes the other way, it's going to ramp up and you're never going to get it at 240.
Yeah, I think
Depends what your
value
risk
should,
profile is.
exactly. And value should dictate. And also, it also depends, I think sometimes, whether you're a big institutional investment manager or whether you're a smaller manager where you do have the luxury to act a bit more nimbly.
So let me get to conclusion on Anglo-American. At current
we
levels,
hold it at
you
the
hold
moment.
it. Are you?
I think it's too early to be aggressive in it.
You're not buying more at current levels. What are you doing with Anglo-American?
I like it very much at these levels.
Are you buying more, accumulating right now?
Yeah, I am.
Paul, what are you doing?
Resources.
I'm not buying Impalas or gold shares at the moment.
Anglo-American, BHP.
I'm saying them Anglo's, Bulletin, Exara, Kumba, Cecil. Those are my 5 plays in the resource play.
I think the resources have turned the corner. They went down 17% in the previous 3 months. I think they've turned the corner and they're now in an uptrend. And you probably find that Chinese news will improve as the year goes on.
So is that where we're going with this? The Chinese story is going to get better?
Look, a year ago, I think I sat here, I just returned from a visit to China, and I just said, you know, I can't see this economy continue to grow at 8.5%. 7.5% is fine to me. And then when their government then downgraded the target, the entire market started to panic, and I couldn't understand it, because you just go there and you realize it's not sustainable to grow at those kind of levels.
As the base gets bigger.
Yeah, but I don't think the China story will go away, because you can still see, just to give you an indication, last year they released their 12th five-year economic plan, and they still planned to invest in fixed assets, something like 10 trillion renminbis over the next 3 years. Now, just to put that in perspective, that is about 4 South Africas. South Africa is about 250 trillion, 250 billion, am I right? Total size of the economy. So it's 4 South African economies that they want to build over the next 3 years. So, you know, so I think there will still be demand for resources, but we know if you just go back to, and that is my concern about Anglo's, if you go back to 2008, if you really hit a crisis, then commodity prices don't fall by 10 or 5%. It falls by 40%.
They collapse. They collapse.
The trucks stop. And that would hopefully give us a wonderful buying opportunity, because
Well,
I'm not longer term, I'm not negative about those.
David, I think you were in studio when Standard & Poor's Conrad Royce was in studio. Very, very bearish, Paul. In fact, he made the statement that he thinks we're going back to 2008, 2009. I am correct.
That was on the
bearish.
basis of European leaders not really taking any firm action.
Well, it's taking a
No, he
very
was.
negative stance on that.
Yeah.
And that means the end of Germany, the Euro. But just remember, Brazil has to prepare for the Olympics and the World Cup, and it's got a lot of construction to be doing.
That's doing it already, yeah.
We also just need to touch on the retailers and industrials and the period that was. Where are we going with these stocks? Because obviously we keep debating it, and they are two
Are you
very...
asking me?
Yes, I am.
Okay.
I'll keep quiet, and you can answer.
No. We don't hold any retail stocks at the moment. For us, despite the fact that the story is still a pretty decent one, that the company results
When
were
did you
okay.
last, sorry to interrupt you, when did you last
We
hold
sold
retail
our last
stocks?
Lewis at $80 last year. So we sold it right at the top, by the way. I suppose we were lucky.
Timing
It hasn't
is everything,
hasn't
well
hit
done.
$80 again. But unfortunately, we never held ShopRite, because it always looked expensive to us. And so that was certainly a cross against our name. But if you just, again, we play in the world now. So you can buy ShopRite with a fantastic story. Paul spoke about Africa and even in South Africa. But suddenly now, Paul, we're not talking about earnings growth of 20% odd now. We're talking 10 to 15%. Those shares are trading at multiples of 22, 23 times. You can buy Tesco, which arguably operates in a terrible area in the world, in Europe, but they trade at a multiple of about 9 times.
What's the return on equity?
You've got to look at that, but the return on the equity, of course, is not as great, but I don't think it justifies that wide gap. Those are my thoughts. But also, even within South Africa, I think you can buy stocks with slightly lower ROEs, but significantly lower price to books than the retailers at the moment. So I think they are priced for perfection. Of course, I mean, if you're a food retailer, there is certainly defensiveness in the earnings stream going forward. But for me, it feels too expensive. And last point that I want to make, sorry Dave, is I think the foreigners are the big holders, because foreigners don't always know the companies well. They buy a theme. Go overseas, you speak to those asset managers, consumer in Africa and South Africa.
And we're relatively cheap compared to other emerging markets in the retail space.
So when they get disillusioned, they will sell those things, and I don't know who's going to buy it from them.
That's the danger, because what's happened, exactly what Alwyn said, for 2 years now we've said retail is expensive. We've lost 46% performance.
Exactly.
Out of it. And suddenly you're saying, hold on a
They've
second.
been right so far.
Yeah, they've been right.
The
Exactly.
foreigners
have called it right.
aren't going anywhere. And we keep saying, all right, go already. Can I let our shares fall? And they don't fall. And the worst thing is that the companies keep producing these spectacular results, like we saw from Fushimi.
And I keep asking, are the foreigners a game changer when it comes to our retail stocks? A game changer.
I think ultimately the value will dictate, and you
know what
don't
I think's
know
gonna
how
happen?
long these things can continue. Can I just, sorry, we spoke about ShopRite, wonderful results, Fushini's wonderful results, but did you see what happened to the SPAR share price?
Yeah.
Marginally disappointing earnings, marginally.
Not a retailer as
It's
such.
not, it's more a wholesaler, yeah.
Distributor, wholesaler, they don't actually retail
But
themselves.
I think
Don't
will
agree with
happen.
that. They sell to the final consumer.
The
Ultimately.
supermarkets. I go to Spar supermarkets.
You know what I think will happen though?
It's a retailer.
Listed company doesn't own the retail.
Sorry, we have
Wow, that was a look. That was a look. I mean, I'd have never seen that before. Okay, I'm keeping quiet, David. Goodness me.
I thought I was interrupting. That's why I looked to you for guidance. But what I think will happen is that the shares might not collapse. They might not go anywhere. In other words, they might not keep pace with the increase in earnings. They'll just, as we see with Capitec or as we've seen with growth companies, they just go, they flatline. As earnings start to catch up, and that's what might happen with the retail. Not necessarily a fall or a collapse or a major downturn, just simply go nowhere.
I just want to make the point with that, Dave. I mean, those companies, and of course, ShopRite is probably the prime example. I mean, those are very, very well-run companies. I mean, if you look at ShopRite, if you look at their margin, 5.1% operating margin, I think that is phenomenal.